Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&M Consulting and Len Suzio of GeoData Vision.
Welcome to our podcast series addressing everything you wanted to know about regulatory compliance, but were afraid to ask. I'm Len Suzio with GeoData Vision, and today I'm joined by Dean Stockford of M&M Consulting. So, Dean, what are you teeing up for our audience for today's podcast?
Hi, Len. It's great to see you. And today I thought I would talk briefly about third-party risk as regulators are continually stepping up their enforcement in this area.
That certainly is a great topic. And I can tell you, Dean, aside from our listeners today, I'm certainly interested in it because I am a third-party provider. I should say GeoData Vision is a third-party provider for many banks. So you're going to have my attention for sure.
Well, fantastic. Thanks, Len. Given the highly competitive world in financial institutions, in the financial institution arena, they typically struggle to keep up with the technological advances, particularly in what we call the regulatory environment. The tech companies are steadily providing innovative ideas to increase efficiency and to provide new services to ultimately maximize the customer experience. And the financial institutions enter into agreements with these third parties and do make significant investments in most cases with specialized companies to deliver products and services that would not otherwise be able to provide have they not gone to the third party. So these partnerships introduce various risks requiring institutions to ensure compliance with the various regulatory laws and, of course, sound business practices.
So, Dean, is the third-party risk you're talking about specific to tech companies, or does it apply to all third parties?
Well, I can always count on you, Len, to ask a great question. So thank you for that. But the third-party risk goes way beyond just tech companies. It can include outsourced services like our company does, consultants, auditors, affiliates, fintech companies, platform providers, processors, and of course, program managers. I mean, it just goes on and on and on. But virtually every third party must be identified, risk rated as to the level of risk the third party presents to the financial institution and managed. It remains the responsibility, though, of the financial institution to monitor these third-party relationships from a safety and soundness perspective and for compliance with all of the regulatory laws and regulations that are out there.
So, as a third-party provider, what should GeoData Vision expect regarding this?
Well, let me unpack this from the lens of the financial institution as opposed to from the provider. There are layers of complex risks to be considered when entering into an agreement with an outsourced third-party provider. Due diligence prior to entering into such an agreement is a crucial first step in order to mitigate risk and, of course, prevent a potential future disaster. Understanding the effectiveness of the third party's ability to comply with regulations and laws, adhere to policies and procedures, and provide for safe and sound practices will certainly provide the financial institution a platform to mitigate risk when performing a necessary risk assessment. So, as a provider, you can expect many questions from the financial institution regarding internal policies, procedures, controls to mitigate risk, and additional documentation regarding systems used, data, how it's stored, et cetera, et cetera.
So can you expand on some of the key topic areas for third-party risk?
Yeah, of course. And these may sound actually somewhat redundant as they're fairly common in what we call the financial institution sector. Obviously, operational risk, failures or disruptions in third-party services that impact financial institution operations, such as, IT failures, cyber incidents, cybersecurity risk itself, where we're constantly trying to protect data. So data breaches, have they had any, hacking, other cyber threats due to weak security measures by the third-party vendor? Regulatory and compliance risk, as I was mentioning, non-compliance with financial regulations by the third party, leading to either a legal penalty for the financial institution or an enforcement order of some sort. Reputational risk, obviously the damage to the financial institution's reputation if the third party engages in something unethical or illegal. And to me, that's a big one. I always like to talk about reputational risk because I think once you've lost that, you've pretty much lost everything. Financial risk. I mean, the third party financial instability leading to, service disruptions or losses for the financial institution overall. The legal and contractual risks that are presented, the weak contracts or legal disputes that are arising from unclear agreements with those third parties. Hence why attorneys have to touch it 50 times before they goes out the door. Concentration risk. I mean, over reliance on the third party provider for critical financial institution functions and systems, that could also be, a challenge for institutions, and therefore should be properly vetted with the third party. And in addition to these types of risks, financial institutions need to manage the other risk, which is the due diligence that they're conducting. Institutions must assess the third party's regulatory compliance policies, their security measures that are in place, controls that are in place before they engage. If risk cannot be mitigated, then alternative solutions should be considered in that particular case. Identifying all the third-party arrangements, a structured process should be in place to track all of those relationships. And compliance teams should be involved in that onboarding and offboarding process. Once again, they want to make sure that they've dotted all their I's and crossed their T's. Risk assessment, it evaluates the third parties based on financial stability, security, personal policies, all the things I mentioned above relative to due diligence and mitigating risks. And so the risks are categorized, and you have some vendors who are considered what we call critical vendors that will be higher risk, where you'll have lower risk vendors just because of the amount of data or the amount of access that they have to confidential data or information from the financial institution. The risk appetite and tolerance. Institutions must define what they would consider an acceptable level of risk. And of course, context is critical. So they have to look at the overall size and complexity of the institution, complexity of the products and services, the people that they're working with, and what is their appetite. That determines the overall strategy that they'll have. While risk tolerances specify, acceptable, what we call deviations from that appetite. Continuous monitoring, ongoing evaluations help detect and manage, emerging risks that may be unforeseen at the time. Adjustments can be made throughout with self-assessments, and of course they can recalibrate depending on what they were told up front versus what they're finding out after the fact. Big one that we're seeing recently, algorithm risk. When third parties use these algorithms for whether it's underwriting or pricing, institutions must understand and monitor the data integrity. Bad data in, bad data out. So in fairness and making sure that we prevent, discriminatory type trends, because these are used in, like I said, underwriting formats as well. And then, critical considerations, contractual responsibilities, once again, data security, breach response, termination policies should be clearly defined, and institutions must assess whether the third-party providers more value than the risk itself. So, there's a lot here, and I know that's an awful lot to unpack in one specific podcast, but it is pretty extensive.
Mm-hmm. Well, I'll tell you what, the due diligence steps and considerations are pretty extensive. When you think about all the third parties a financial institution typically uses, this looks like a full-time job.
Well, that is a very good observation, and you are absolutely correct. In most cases, it is a full-time job at most institutions, and quite frankly, I find it in my own shop, Len, to be somewhat of a full-time job, just responding to the due diligence questions you get from the financial institution. So, as each institution is a little different, and they must tailor their third-party risk management approach based on the unique needs that we spoke of earlier, and again, putting some context behind it.
I just have to throw a quick curveball here. We get these questionnaires all the time, just like you do, Dean. And sometimes they run several dozen questions, most of which don't apply to the services that we're providing. It's kind of these questionnaires are kind of designed as a catch-all for any and all potential types of third parties. And sometimes this can be pretty frustrating when you look at one question after the other that doesn't necessarily apply. I wish that some of these institutions would just say, okay, for a third party, a vendor who's a consultant versus a software vendor, let's say, where the institution is relying every day the functioning of that software. I wish the questionnaires distinguished those kinds of responsibilities. And of course, that the risk associated with a software vendor is far greater than someone who's giving advice and not, something that the bank relies on in its day-to-day operations. But
yeah, you're absolutely right. Yeah, you're absolutely right, Len. And what the real issue there is what we're seeing, at least it's kind of trending, but it has to do more with the amount of data that includes non-public personal information, some sensitive, critical data. And the level of questions are certainly around the cybersecurity and IT functions. There's no question about that. How you store the data, where is the data stored? How is it encrypted? Do you have multi-factor authentication? I mean, I could go on and on and on, but as you know, we try to keep these podcasts somewhat brief. So
Right. So I was reluctant to kind of throw that in, but I just said that's so important.
Yeah.
But this is great information. Before we end today's podcast, do you have any additional thoughts that you'd like to mention for our audience today?
Yeah, just one. I mean, it should be expected, that every financial institution will view third-party risk differently. So it's not a one-size-fits-all. It'll be based on the complexity, size, the scope of the individual institution and situation itself. Third-party risk assessments are not intended to be identical, and each should be tailored accordingly to the institution. The assessment should provide clarity on those riskier areas when engaging with third parties and relevant information on how to manage the risk in more complex relationships occurring outside of the institution. And then ultimately, the board of directors who are, they're responsible for everything, but they're also responsible for the oversight of the risk management and the overall safety and soundness of the operations of the financial institution. And each agency expects, consistency, but examine using its own processes and procedures. So I think people have to be cautious. A third party has the ability to sell any useful product, but will sometimes refuse the risk itself. So we've got to, I always say you got to kind of drill down into that relationship and ensure that we've provided enough or appropriate risk mitigation overall based on the complexity, size, and scope.
Yes. And Dean, this certainly has been another great topic and a timely one, with the regulators putting even more emphasis on monitoring third-party risk exposure. So I thank you for the invaluable and informative comments you made for today's audience. This is Len Suzio from Data Vision.
And this is Dean Stockford from M&M Consulting saying thank you for tuning in to today's discussion. And to all you compliance officers, legal teams, and financial professionals out there, stay ahead of the curve and continue to adapt as these changes unfold. We hope you found today's episode helpful in preparing for future of financial institutions compliance. And please let us know of any additional topics you'd like to hear in future episodes.
Thanks for listening to the Compliance 911 Show. If you like the podcast, be sure to subscribe so you don't miss an episode. While you're at it, please give us a like and review to help others find the show. As always, links are in the show notes, and you can always find us online at compliance911show.com. Follow M&M Consulting and Data Vision on LinkedIn for all the latest news and information on compliance hot topics.